Here, Kalamazoo County.
Sandy Doctor.
Here, Kalamazoo County.
Dan DeMint.
Dan, you need that. There you go.
Here, Allegan County.
Okay. Dean Berge.
Here, Maricopa County, Arizona.
Randy Eberts.
Here, Kalamazoo County.
And Chair Bob Salisbury.
I'm here. I'm in Manatee County, Florida.
Okay. I'm going to share the agenda here. There we go.
Steve, could you introduce guests, please?
Oh, absolutely. We have Mayor David Anderson, City Attorney Clyde Robinson, Greg Validstra, CCTA, Deputy Director of Support Services. And in the background, we have Nina Porter, Management Services Coordinator.
Okay, thank you. Next item on the agenda is to review the minutes of the December 2nd meeting, which were included in your package. Could I have a motion to approve those?
So moved.
Support.
Support.
Motion support. Any discussion? All those in favor of approving the minutes as drafted signify by saying aye.
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 Anyone opposed? The minutes are approved. So next is the investment portfolio. Steve, the assets December 31st.
Okay, let me just get to the proper page here. Okay, so as you can see here, at December 31, we had total assets of just under 845 million, split into the various buckets of 705 million for the pension assets, 105 million for OPEB, and 34.7 million for CCTA. A vast improvement year over year, as we'll kind of see as we go through the other reports. And you can see at the end of the year also that we are right at our policy levels for equities, fixed income, and real estate. So our rebalancing was able to hold pretty well through the end of the year with minor changes. So I guess to that point, any questions on total assets?
So Steve, the total equities were at just over 70%, just slightly over 70%, and with policy max and the Public Act 198 is, or I guess Public Act 485 now is the 70%. The slight overage we don't anticipate being a problem. Is that correct?
No, we've discussed this with our auditors in the past, and because if it was like a 5% variance, it would probably be a little less forgiving about it, but they do know that we make best faith effort, and knowing that year end also involves a number of holidays that can make it difficult to transfer or to do a rebalancing closer to December 31. I think this being off by 0.14% has been deemed acceptable by them.
Okay, thank you. Any questions of Steve on those assets? Hearing none, Rob, let's move to the investment portfolio, please.
Great, thank you, Bob. Just very quickly, would like to go over what happened in the markets during the fourth quarter to frame the conversation around investment vehicle performances. Fourth quarter was very strong for equity. The S&P 500 was up 12.2%. What really signified the quarter was the rebound in both value and small cap. Rotation was very strong. So I mentioned the S&P 500 being up 12.2%. During the same quarter, the Russell 2000, which is mostly small cap stocks, was up 31.4%. So that was great for this portfolio from an absolute performance standpoint. Secondly, I'll just point out that on the fixed income side, there was a rotation away from safety, away from the safe havens of US government and agencies. So the US government index, the Bloomberg Barclays, was down 0.8% for the quarter, and the US corporate high yield index was up 6.5%. So for portfolios like yours that are all very high quality credit, you didn't perform as well as the high yield guys did. So With that, we'll go over the city's numbers. Market. So I'm on second page, I believe. Actually before then, but the market value of the assets, 755.9 coming into the quarter, rose to 844.8 million. That was an increase of 88.9 million or 11.76%. The portfolio return weighted average net of fees during the quarter was very strong. It was up 13.09%, and the one-year number was up 9.25%. The annualized return since inception back in October of 1982 is positive 10.8%. As we've referenced, equities slightly over allocation at 70.1% at the end of the quarter. Equities returned 18.5% for 8.54% in the quarter and 9.25% for the year. Fixed income pretty close to target allocation at 24.8%. That was up 0.83% in the quarter and up 10.24% for all of 2020. Real estate was right at target allocation at 5%. The assets real estate returned 4.79% last quarter and was negative for the year at negative 1.73%. Inflation adjusted, the real return during the quarter was 13.02%. Since October of 82, the real return net of manager's fee was 8.21%. So if you want to go to that pie chart, if you're going to flip through them, Steve, thank you. Only thing to mention here, if you scroll down a little bit more on the left-hand side, we do show the asset classes, the over and under versus policy, very close to where they should be. 97.5% of the portfolio is liquid. The only part not being liquid is the REIF real estate. I'll go over the Jenison portfolio performance here since it's all here on this page. Jenison's duration slightly lower than the benchmark. The Bloomberg Barclays US aggregate is at 6.1 years. They're just a shade under 6 years. What Jenison did last quarter, and they had done the quarter before, is they had moved away from treasuries and agencies and into corporates and asset backs. So as a result, that sector allocation for them added 58 basis points to their performance. Their net performance was 23 basis points over the index, and we'll see that a little bit later. Next page, Steve. Simply showing the volatility of returns and what happened during 2020. It was, as we can all recall, the most volatile year that we've had since 2008. It shows up in the numbers, but the last 3 quarters of the year, all positive. The next page shows the annual returns, and since inception, shows we're up 9.25% during 2020 and slightly below the long-term average of 20.8% going back to 1982. Next page simply shows the variances again. We've already mentioned those. And actually this looks a little, yes, yeah, it does dovetail. So there's nothing really away from the benchmark that's worth noting. Everything's close to allocation as of 12/31/2020. The next page, Steve, the rate of return by manager. Extremely strong quarter for equities in total. This portfolio's equities returned 18.54%. I mentioned during the quarter there was a rotation away from large cap tech that had dominated returns really since 2016. There was a rotation back to small cap and back to value. So DFA funds definitely benefited from that. 2 of the funds were up more than 30% in the quarter, US small value, US micro cap. Emerging market value also had a strong quarter, up nearly 21%. And the best performer relative to its index was DFA's US large cap. So very strong quarter on the equity side. The fixed income side, we mentioned Jenison, up 0.83%. They did beat their benchmark, we'll see that. Real estate up 4.8% for the quarter. So total for the quarter up, net of fees, a very strong 13.09%. Steve, if you go to the next page, the manager returns versus the benchmarks. You see, US microcap, I pointed this out in the earlier two meetings. The quarter was fine. It was close to the benchmark. Clearly, the tracking error for 2020 was huge, negative 13.5%. I think underperformance was part of it, but as we've discussed, there's not a good benchmark for the DFA US microcap product. And that is because it fits in between, from a market standpoint, in between the two major indexes you might use. We use the Russell 2000 for benchmarks. DFA uses it for benchmarking purposes, but that benchmark is an average market cap of 2.6 billion. The microcap fund is an average of 1.6 billion, so almost half as big on average company-wise versus the Russell 2000. So then looking at the Russell microcap index, which would be the most logical, that average market cap is only 800 million. So it's right in between the two extremes. You're going to get tracking error no matter what. DFA does use the Russell 2000. I'm sure will continue to use it. It will continue to show tracking errors. And when I look at it on a quarter to date basis, just to see how it's done this year to date through Friday, the microcap has actually outperformed the Russell 2000 by almost 200 basis points. So the other DFA products, so small value did a very strong quarter, but slightly underperformed its benchmark, as did international small value. DFA emerging markets was slightly under their benchmark, 2.06%. The star performer out of the DFA, the 5 funds held, is DFA US large value, which beat its benchmark by 2.24%. So the first 9 months of the year, very tough for DFA products all across the board. Small in value, out of favor. Again, the only thing that really worked for the first 9 months was large cap, and particularly large cap tech. Does not favor DFA, but DFA definitely participated in that rotation that we saw during the fourth quarter. Next page, if you would, Steve. Jenison, we mentioned, outperformed its index 16 basis points here. The Vanguard REIT we have talked about. Vanguard REIT is one we're going to revisit next quarter in terms of the benchmark. The fund itself had a change of benchmarks back in 2016, so they could take advantage of an emerging asset class within real estate that was not a REIT, which happened to be cell towers and also secondarily timberlands. But as a result, they switched to an MSCI benchmark that had no history. Because it had no history, we did not include that. We used the next best fit, the Dow Jones US Select REIT. However, now that benchmark, the MSCI Investable Market Index, 25 to 50 real estate, I know it's a mouthful, that is the index that the Vanguard product tracks against, and they tracked perfectly against it. So what we will propose is that we'll splice the benchmarks up until 2016 for the old benchmark, and then post 2016 to the new benchmark. And what you'll see for the Vanguard performance, of course, as with all their index funds, it tracks very tightly to an index. Any questions on that? I know that was a lot. Okay, next page, if you would, Steve. So this is the 5-year look, and again, not favorable relative for DFA versus their benchmarks. Again, I believe the US microcap at a negative 3.62%, 5-year versus Russell 2000 probably isn't the best way to look at it, but I don't know of a better one. But it's underperformed the Russell 2000 for sure. US small value under, international small value under. Emerging market is the only DFA product for 5 years that has outperformed its index, up 51 basis points. And DFA US large cap value down 51 basis points, coming back strongly most recently. So the Jenison has done well and has added value. Vanguard, I just mentioned, it's up 5.66% over the last 5 years. This is not a good index to go up against. When we show you the index next time, they'll be within basis points of it. And REEF over the 5 years has outperformed the ODCE index by 56 basis points. So they are adding value as well. Next one, Steve. Now here, we've had this discussion the last 2 times. If you take a look at the planned returns, 13.09, upper left-hand for the 3 months, it trails a benchmark composite. That's really a function of the fact that the portfolio was not rebalanced on October 1st. So because equity got hit earlier in the year, equity was underweight, and in particular, the products that did extremely well in the 4th quarter. DFA small cap, US small cap, and DFA international small cap value both had, and microcap, all 3 had great quarters. They were all underweight our target allocation. So if I take the target allocation and the actual returns from all of the funds used and shown over the prior 2 pages, the calculation comes up, the portfolio would have returned 13.86%. which would be only 13 basis points below the composite benchmark. So the point here being, it was a really good quarter on an absolute basis, and it was pretty close. It would have been very close to the benchmark had the portfolio been rebalanced on October 1st. That's it on this page, unless anyone has any questions. Okay, Steve, the next one. Simply showing the since inception returns, nominal return since 1982, 7.26%, and a real return of 5.22.
Hey, Rob, this is Dean.
Yes.
I think those numbers are not right. Shouldn't they
Thank
be
you.
10.8 and 8.21?
You're right. I know we just looked at it in the chart before that showed the annual, the bar chart. So Steve, if we could back up to that. Yeah, since inception, 10.8. Yeah, that's a good catch, Dean. I'll look at that. It needs to be cleaned up. It's not the correct number.
Okay, thank you.
Thank you. So the correlation page, we don't often spend a lot of time on this because it is relatively static. If we don't move assets in or out, the relationships don't change that dramatically. But the only thing I have been pointing out is that DFA's US microcap and their DS US small value have a 1.00 correlation, simply meaning you're not getting any diversification benefits by adding both of those. Now, they are different products, and the DFA US small value is more value, but the overlap is pretty significant between the 2 funds. They tend to track very closely performance-wise with each other. This page, the only thing I focus personally on is the alpha. That's what matters. And you can see for the DFA funds, it's the same picture that we've talked about for the 5 years. It is negative for all of the DFA funds except for the emerging market value funds. Next slides, if you would, Steve. We won't spend any time on this. This is just for your benefit, for reference. Take a look at some other assets, some other funds, some other indexes, index mixes, how they performed against how your the city's plan performed. So we can go through those 2 pages and go to the matrix, standard deviation return. The only thing we've been pointing out here is the dichotomy between the REIT performance, which is real estate, and the Vanguard REIT, because they've had comparable performance over the last 5 years, but because REIF is a private entity, it's a private fund, they value it themselves on a daily basis. They do have auditors come in and revalue it quarterly, but it takes out all the volatility. So whereas the assets themselves may not be that dramatically different, the assets held in Vanguard REIT versus the REIF fund, the volatility looks dramatically different because the Vanguard REIT is subject to public forces that change the prices, often significantly on a daily basis. That is it for the city. Any lingering questions or anything I didn't address? Anyone wanted to mention?
Rob, I'd like to go back to the correlation matrix just for a second.
Okay.
You mentioned the, the correlation of 1 between the small cap value and the DFA micro cap. How much different is that from a 0.95 between BlackRock and large cap value? And that has a much larger share of our portfolio than the two Microsoft or the two small cap funds, right?
Yeah, so which, I'm sorry, to be clear, which two are you comparing?
The first two there, the 0.95 right there, upper right, upper left.
Right.
Yeah.
Right.
0.95 isn't far off from 1.
It's not, but I think that's pretty significant. If you take if you just took a 1-year snapshot of the returns on the S&P 500 versus DFA's US value, you would see significant difference. But this case in point on the US microcap versus small cap, just for the quarter, if you look at those returns, and they do vary over time, but for the quarter, US microcap was up 30.53%, and DFA US small value was up 32.57. That's pretty tight. Now, the DFA large value that we were just discussing was up 8. I'll wait till he's done scrolling. Thank you. Was up 18.49, and when you move up and take a look at the S&P 500, that's 450 basis points below at 12.16. So the tracking difference between US large value, DFA, and the S&P 500, I think is pretty significant. I don't think it's that significant between US small and US microcap from DFA.
Well, I don't want to belabor this much, but that was one point in time, and this is a 5-year
Right.
correlation, and that's based upon daily, quarterly. What's the valuation?
Valuation or the correlation?
The value. Well, how many times? What's the frequency of valuation each day? Is it each quarter, each month, each year?
It's daily returns.
Daily returns. Okay.
So I think the important point is that while it's interesting to look at the correlations, that when we enter into do the overweight in small in value, it's not really for diversification benefits as much as it is for expected increased return, because you're trying to capture the premiums. But I don't think it's sold on the basis of diversification.
Yeah, I was not trying to suggest that, but simply point out that those two, one is 10% in the portfolio, the other 5%. I know Sandy brought it up maybe during the first meeting, but in total, the entire value weighting within the portfolio is high, much higher than the market. And you have, I was pointing out 2 products that are fairly similar. When you look at them on the Morningstar style box, there's not a lot of difference between those two.
It is interesting that maybe this is to your point, Bob, that if you look at the since inception performance of the micro cap and the small cap value, 38 years, that's a long time. But the micro cap has outperformed the small cap value. So that might, make if we decide the correlations are closed, and so we move on and look at performance differential, it could make the case that maybe we need more micro cap and less small cap value. Potentially, but we're going to do that study and then we'll know.
I think we'll have a better idea, but yes, and certainly looking at the past the question is that how much is that predictive of the future, and how are we going to forecast it? The inputs into that study are all going to be very interesting.
Yeah, I agree. Thanks, Rob.
Thank you, Sandy. So I think that's it, Steve. If you want to scroll back down for the city, there's nothing to say on the benchmarks. We'll discuss the Vanguard real estate benchmark next quarter.
Okay, any other comments or questions on investment performance? If not, then Steve, we'll move to the review of expenses.
Okay, so we'll start here with the expenses for the pension fund. Pretty stable with our benefit payments throughout the course of the year. Just kind of going through the fourth quarter, obviously less activity at GRS at this point of the year. fourth quarter is not a whole lot going on. We're just starting to get into that again, first quarter, and kind of track how that goes through the year. We're get that spike in that first and second quarter. Everything else fairly standard. Nothing too large to really note that's different than normal. As we can see, we're always tracking a few months behind on State Street as we're only through October on their billings. And then there is a delay that they're working out some issues. They're a bit behind on their retiree fee billings. They're only through July here. But, you know, even if you look at the dollar value, it's not going to be huge impact for us as we think about that. And we've been working with them. I don't know the specific reason why, but their back office seems to be just a little behind on a few of these items. So in total, pension expenses for the quarter of $8,052,919. Moving on here, we have investment expenses related to the pension system. Again, everything pretty standard. You know, as pretty much anything, the only thing I'd point out, which everybody is pretty well aware of, is the higher the fund, the more the fees on the whole, or the higher the balance. So nothing nothing out of ordinary on any of these that I've noticed. And then total with investment fees, total pension expenses of $8,527,328. Any questions on the pension fees or expenses? Okay. And then moving on into the OPEB or Retiree Healthcare Fund. As we see here, our retiree healthcare benefits stayed pretty stable throughout the year. Do want to note that year over year, that's a decrease of about 800,000 in benefits or in healthcare benefits that were paid out. And I would attribute that largely to COVID, with a lot of doctors' offices actually not seeing patients as regularly as they previously were. So I'm sure that as things normalize, that amount will kind of get back to where it was. Although we will see additional benefits moving forward of the new retiree healthcare plan. So perhaps we're trending towards a new normal where we won't see that increase come back. At least that's the hope. Again, as you see here, we talked about premium benefits. We had a spike as we were implementing that plan and getting everyone onto through their incentive plans and getting them signed up for Medicare. As we see here, that number has significantly decreased and will start to normalize at a lower amount as we move forward. Moving on, other expenses are pretty normal as standard. Nothing else that really caught my eye as being outside the norm. And so total pension expenses then or OPEB expenses with investment fees for $2,577,010 for the quarter. So I'll open up to questions and ask for approval of the expenses for the pension and the OPEB fund.
So could we have a motion to approve those?
I'll move to approve.
Thank you, Dean. Motion support. Any discussion around the expenses that were summarized by Steve? Hearing none, Steve will do a roll call on that, please.
Okay. Nick Griffith,
Yes.
Joshua Sledge,
Yes.
Sandy Doctor,
Yes.
Dan Dement,
Yes.
Dean Berge,
Yes.
Randy Eberts,
Yes.
and Bob Salisbury.
Yes. Motion's approved. Thank you. Steve, move us on to cash flow, please.
Okay. So kind of moving into our cash flow. Let's see. Sorry, trying to get the whole sheet on the page here. You know, a good quarter for us. Again, after reviewing expenses, you know, the disbursements were pretty well on par. Receipts are a little bit higher. Look at the actual column here on the far right. Receipts were a little higher than expected. I think just due to timings of payrolls and that, you know, that's usually what causes our ebbs and flows there. Overall net cash flow of negative 7.6 million. Once considering investments, we saw an overall increase of the balance of about about 80 million, 70 million, sorry. Again, good quarter. We can see the needs of investment return to continue to support our cash flow. Any questions on pension cash flow?
I guess there aren't, Steve. Let's move on to liquidations then.
Yeah, OPEB cash flow cover here real quickly.
Oh, okay, OPEB, okay.
Similar to pension cash flow, except we have an additional employer contribution on OPEB. It's still between the employer and retiree contributions. We still are not covering the full expenses. Not quite as dramatic here, where we only see net cash flow of negative 1.3 million. Again, supported by investment balances, which we've seen the increase there from 94 million to 105 million. So again, a good quarter overall, and open that up again for any questions before I move into liquidations.
Hey, Steve, just remind us in terms of debt repayments, is that all a balloon kind of payment, or how does that work?
That is a fairly static payment every year. The city and its partners make that payment. The overall debt balance is right around 82 million still. So you've seen, an increase in the investment fund from that debt over the past 5 years, while still being able to pay the additional benefit.
Okay, so that payment is being made directly by the city as opposed to coming out of these cash flows. Okay.
Correct.
And roughly, what was the interest rate on that debt?
I hate to venture a guess. I want to say it was somewhere around 3%.
Okay.
I can have the exact number on that next time.
So this was all an arbitrage situation where you were borrowing money, hoping to return more than the cost of borrowing. And so far, we appear to be doing that.
Correct. Yes, it's been working very well. So moving into liquidations for the plans, pretty easy decisions this time around, with the significant overage in the BlackRock fund for, I believe it was all 3 months as I move forward. There was not a whole lot of debate over where we should be liquidating from for those for October, November, and then we have our full rebalance that was done in December. And again, you see where BlackRock, even in our December 17th rebalance, was almost 2% over its target, where each other individual investment vehicle was just at or just under its overall target. So we were liquidating, rebalancing out of BlackRock into the other funds.
And Chris, in our previous meetings, we talked about the possibility of moving money into REEF. It doesn't look like it's necessary with the city situation because they're pretty close to their allocation. Is that a correct interpretation?
That's as of the 17th of December. As of the end of the year, yeah, there was enough movement to really want to move about 800,000.
But maybe we ought to take a look at the actual balance in February before we make a decision.
We can do that.
So I think in keeping with the decision that we made with the previous organizations is you'll take a look at the balance as of the end of February in the REEF versus its target allocation to decide whether it's appropriate to make a deposit into REEF. And the reason for doing that is it's our understanding that there's, after the end of March, there's going to be a queue for being able to put money in. So this might be the last chance to do it if we are under balance there. So I think in keeping with the decision that we previously made, we should do the same thing here.
Yes.
Okay, Steve, anything else on liquidations?
I think that covers it for me.
Okay, why don't you report on actuarial reports, please?
So nothing at this time. We are in the process right now of working with our actuaries to gather the data as of year end to submit to them. So nothing special, nothing to really report at this time. Obviously, we will. Our plan is to have those actual reports by June 30th, in part due to our audit, and then also hopefully to have it we need it for our audit, so that's the largest driver of that. So really nothing to report at this time.
Okay. Then I'll move to the due diligence, et cetera. First, dealing with activity reports for Chris on page 41.
Okay, you have the activity report for the REEF. Well attended. I thought it was well done. We've already discussed putting money in. We'll take a look at the end of February what the balances are. So I really don't have any comments unless there's something the committee wants to go through.
Okay, and what about future due diligence and education?
Everything will probably be virtual. Nothing is planned as of this point.
I think we did a good job in this interesting year doing all of the due diligence that was necessary through virtual meetings, and we can continue to do that, and maybe we'll do that ongoing in the future. Chris, mention the corporate governance item, please.
Mr. Spieth retired from DFA as the relationship manager. He's been with DFA since '82 and been associated with Kalamazoo since '83. He's been replaced by Mr. Andrew Colatonio, based out of Charlotte. I would like to put together a little memo of appreciation to Mr. Spieth, and I will circulate it when it's done.
Okay, thank you. We'll move on to derivative reports, and even though Chris is listed here, I think, Rob, you're going to do those, right?
Yes, I will. So if you want to scroll to that, Steve. So yeah, BlackRock, it's de minimis. The total amount is about 850,000. The portfolio is 250 million plus in assets. It's less than 0.5%. I'm assume that they're using that just to manage their cash flows in and out. So certainly not a risk factor. Next page. Jenison, I compare Jenison, we talk about it every quarter. I just compare them quarter over quarter, take a look at the contracts outstanding and notional value and how that changes. And for their purposes, clearly they felt they needed less derivatives in the fourth quarter. So they actually dramatically make it significantly reduce the number of contracts that they used and the notional value outstanding. So, not much risk, less risk certainly than the quarter before.
Okay, thank you, Rob. Chris, would you do articles of interest, please?
We've gone through the articles of interest, just the 4 of them. But the only one that we really want to get into, unless you have questions about them, was the something of value with Howard Marks. The P&I article was really meant for plans that do not apply to the city and the county. The donor advised for was meant for the foundation. And the Morningstar Barometer was just an interesting article that Randy passed on that you can review at your leisure. But the article on something of value was, I think, something that we wanted to discuss at your convenience, Bob.
Okay, so that moves on to the old and new business, whether we talk about the role of value in the portfolio. And that's partially stimulated by that article from Howard Marks that Sandy had distributed to us and which was included with the package. And the discussion that we've had around that article in our previous meetings is that we as a group feel that the time has come for us to revisit our asset allocation with the overall view of determining at least partially whether it's appropriate to maintain our existing overweight to value and to small, as well as other asset allocation issues, including the question of alternatives, which we've reviewed from time to time. And as was suggested in one of our meetings, the question of should we be including an allocation to ESG. So our discussion has led us to the conclusion that we do want to do a thorough and rigorous asset allocation review, that we want to rely on as much information as we can, and just not just DFA, even though DFA provides excellent research and very good, smart people. There is the possible conflict of interest between them providing research and supporting their own products, so that we do want to include as much outside non-DFA information as we can. So I think as a committee, we've concluded that now is the time to start another asset allocation review. It's going to be a thorough one. It's going to take a fair amount of time, and it's going to take quite a bit of work from Chris and his colleagues at Zhang as we work through this process. So I think that's just a summary of some conclusions that were reached. You'll hear a lot more about this in future meetings, but I'll stop and let any other committee members add anything that they want to that thought process.
I would just say that I especially appreciate having our new committee members. I think Josh and Nick will bring experience, that our committee hasn't necessarily had yet. So we'll see where that takes us. But I appreciate that having that expert, or at least that experience, on our committee.
Okay, good point, Sandy. Thank you. Any other comments from other committee members? If not, I'm going to go to the gains from security lending. Could you take us through that, Chris? That's on page 60, I think, of the report.
It's pretty self-explanatory. It's showing what the gains were from securities lending. It's about a little over $500,000 through all of the clients, through all of the sponsors. I will do these essentially annually, because the information is a little hard to get at. But I hope that was valuable to you.
It is interesting, and it obviously shows the value of securities in the context of all the stuff that's been going on with GameStop and other shorts. I guess if we have GameStop stock to lend, we can make a little money on the thing.
Yeah.
Okay, let's move to Eno Insurance. Steve, you're going to take us through that, or is that Chris?
I can. So I can take you through that. So I've provided as part of the packet the review that was done by Sarah Brundage at Honigman. She had reviewed this policy when we first took it out. What was that, 5-6 years ago? So she just provided a re-review, and in there provides the limits of its $5 million aggregate for all claims under the policy. Covers a handful of things, most importantly, directors and officers insurance. As long as directors and officers are acting within their allotted duties, this policy would cover them for any claims that would be, brought against us. She found it to be, an adequate policy, comparable to, other coverages that are out there. It seems to cover what we've been looking for. So I guess, to that point, I'd like to open up if anyone's got concerns, questions.
Steve, this is Dan. Is this essentially the same policy that the county is carrying? Do you know?
I do not know offhand.
Okay.
I have not coordinated with the county on this. This was virtually the same policy that had been originally taken out by the city. So if the previous CFO had coordinated with the county, then the answer would be yes. But if not, I'm not sure.
Thanks.
Steve, what I found interesting was that, her review of this policy said that it seems just fine, but sort of jumping ahead to our next meeting with the FFE,
Yeah.
It was interesting that she found some shortcomings with the wording in that policy. And it sort of surprised me. Aren't you using the same broker or the same coverage carrier for both of those?
So we can definitely get deeper into the details, but it is a different insurance company that had brought that policy. So we're still going through our insurance broker, but they, go out to the marketplace and receive bids and quotes from various insurers. And so, as we get into that, I have her opinion. I also have recently received an updated opinion from our insurance broker, so we can discuss that during that meeting.
Okay, thank you. Any other comments or questions on the Eno Insurance? If not, I'm going to the next page on the agenda, which it says that it's time for public comment, Steve, I believe.
Yes. Is there any public comment for this meeting?
There are no comments at this time.
Okay.
Okay, then we'll move to the PCIC report. And Katie, it looks like you're going to do that for us.
That's me. Good morning, everybody. Does anyone mind if I share my screen?
Okay. Did you want to do it or do you need me to do it? It's up to you.
I will share it right now.
Okay.
All right. Can everyone see the narrative?
Yes.
Yes.
All right, perfect. So I'll keep, for the sake of time, I'll be as brief as possible. During the fourth quarter of 2020, perpetual care assets increased from just over 3.9 million to above 4 million. The net return for the quarter was 6.85, 14.31 at 1 year. We still have a very balanced portfolio, 50-50. I had processed a distribution request mid-December on the 14th and rebalanced at that time. We'll see that a little bit later, that we're well within target allocations. Equities, as Rob had mentioned, did quite well for the quarter, 13.29 overall. Fixed income, not quite as well performing, only 0.49% for the quarter. If we want to move on to this page, I'll zoom out just a touch. Okay, so we're looking at a since inception return of 6.38%. And our geographic exposure, just under 90% US, 10% foreign, no foreign currency exposure. On the right-hand side, we've got 9,166 total stocks, 18,600 total bonds, well-diversified portfolio. Down near the asset classes here, again, 50-50, well-balanced at the end of the quarter. Target allocations here, variances are very small, nothing too drastic that needs to be addressed at this time. In terms of quarterly and since inception net returns, our last quarter return 6.85. Since inception, we're looking at a net return of 6.38%. We had a bit of a downturn at the start of 2020, but I think we've recovered quite nicely back to fairly stable performance. I'm going to zoom in just a little bit here. Again, we're looking at well performance out of the equity managers. Vanguard small cap really outdid itself, 27.10% return for 3 months. And the only manager that didn't do quite as well this quarter is our DFA intermediate government fixed income, negative 0.86% return. And if I'll zoom out so we can see this. So here we have our funds versus managers at 3 months, year to date, 1 year. This format's I think slightly different than last quarter, just to make room for everything. Again, here we have one of the larger differences between fund and index. I think I'm going to be taking a look at what this is and what the makeup is between our Vanguard dividend growth and the Russell 1000, and see if that's still an appropriate benchmark, as we had talked about with the other entities earlier.
Katie, I can help you there very quickly. Did take a look at Vanguard dividend growth. It's a fund that's has a fantastic 20-year track record. Unlike most Vanguard products, it is not an index product. It is managed, actively managed. Great long-term track record. 2020 was a very poor year for the fund relative to the Russell 1000. The reason why is Vanguard dividend growth is, if you look at the style box, much closer to large cap value. It's not in the middle. And I think the sector breakdown really kind of tells the story for the performance. The Russell 1000 index has 25.1% technology. Vanguard dividend growth has 5.5%. So that and communication services, which is largely technology, that's 11% in the Russell 1000, and it's less than 2% in Vanguard dividend growth. So to wrap that up, the reason for underperformance for Vanguard dividend growth is they are much less growthy than the Russell 1000 and almost no technology weighting versus 25% in the Russell 1. That's it. Thanks, Katie.
Thanks, Rob. Really appreciate that. On our next page, we have the same comparison, but on a 5-year basis. Fairly standard items are tracking, I think, quite well with their respective benchmarks.
Katie, in the
Yes.
interest of time, I'm going to say I think you've done a good review, but I think we'll want to move along unless any committee
Sure.
members have some questions about any of the other material. Hearing none. Thank you, Katie. Sorry to cut you off, but I just
No
want to
problem.
make sure that we stay on schedule.
Sure.
I'm going to go to some closing items. Future meetings are listed on the agenda. And I'll do around the table, but first thing I want to do is just ask Clyde, do you have any update for us as to future meetings being virtual versus in person, where things are going with the state about all this?
No, I don't. I can tell you this, that we are operating under two different constraints. The first is the emergency orders that have been issued by the Michigan Department of Health and Human Services regarding public gatherings and use of face masks. They issued a new one earlier this week because the one that was issued in January expired. The one that was issued earlier I think it was issued on the 21st, and that now expires on March 29th. The Open Meetings Act amendment, that's the other constraint that we operate under, for no reason virtual meetings, that expires on the 30th of March. I mean, it runs through the 30th of March. So you've got those two constraints or guidance that will expire just before the end of the month before the end of next month. I am told that the legislature may be working on an extension of that no reason virtual meeting platform, and I'm attending a meeting tomorrow with our Michigan Municipal League lobbyists, who hopefully will give me a little more information. That said, since I don't know where the legislatures, how quickly they're going to act, whether they're going to act, and then we, on top of that, have the Michigan Department of Health and Human Services guidance that's going to expire before the end of March, we're in a state of flux. What I anticipate doing, and the best I can do, is there is a provision in the Open Meetings Act for a local declaration of emergency. And I'm going to keep my finger on the pulse, but absent real good direction or new legislation, it is likely that the city commission will be adopting some type of emergency declaration that would cover all of its subordinate and appointive boards, that we're going to declare emergency that would permit these boards, both this committee as well as planning, zoning, and other subordinate boards, to continue to meet virtually due to the COVID pandemic. The fact that we're continuing, although the trend is toward fewer cases and more vaccinations, we are certainly not out of the woods. As recently as yesterday, Dr. Fauci indicated that there's not going to be vaccines available, widely available, until probably late spring, early summer, and we still may be wearing masks and the like well into 2022. So given that situation, I think that we're on good grounds to say there still is a health, safety, welfare threat, and that we're going to take local action so as to permit virtual meetings. And that's the best advice, best overview I can give you.
Well, that's helpful, Clyde. And our next meeting being May 26th, I think it is fair to assume that there will not be widespread vaccination at that point. It would sure be helpful if the city could act and allow us to continue to meet virtually, because some of us still don't feel real comfortable traveling.
Right.
So I'll then go around. I guess before I go around the table, Steve, I see that we're coming right on 11 o'clock, which is time for the FFE meeting. Is that going to be on this call, or do we have to dial in separately?
We'll stay on this call.
Okay, so that's helpful.
So we can wrap up the first meeting and then start that one here when we're complete.
Okay, great. So let's do around the table. Randy, do you have anything?
Nothing.
Dan?
Nothing.
Dean?
Nothing here, Bob.
Sandy? Sandy, you're muted, but I assume
Nothing.
that. Okay, thank you.
Nothing.
Nick?
Nothing here.
Josh?
Nothing.
And I have nothing further. So with that, I'll adjourn the meeting. Thank you all for your participation. Oh, I'm sorry, David, I should have given you an opportunity. Sure, go ahead.
I know you're keeping us on schedule, and I respect the heck out of that. I've been in your position quite a bit. So I appreciate the patience. I'm not going to be on the Foundation for Excellence meeting, so I just wanted to do this. Welcome the new members to this board. I appreciate your willingness to volunteer, and I was honored to participate in the City Commission, approving your appointments and the good recommendations to have, great new members on this board. So thank you so much for that. I just wanted to also say that, I often, and I don't know how often this comes up in your life, but when I think about this board, I often think of it as a group of quiet superheroes and who do not draw attention to themselves, but whose work is of foundational importance to the city of Kalamazoo. We recognize people who work for the city who might be out in sub-zero temperatures fixing a water main, some Sunday night, or responding to shots fired calls, or fighting a fire, or doing all that good work, keeping our water safe. But for us to have between 650 and 700 good employees at the city of Kalamazoo, and the benefits that we can offer and the responsibilities that we are obligated to provide related to the pension. Sometimes we use a phrase that your contributions are immeasurable, but I will actually say in this case, I wouldn't use that term because they're actually very measurable. We measure ourselves and scrutinize that, and due to this great work that this board has done now all the way back to 1982, that it makes a night and day difference to the city budget, what the city can do. So I just want to thank everybody profusely. I really appreciate that, and just thanks for letting me have a moment to talk.
Thank you very much for your comments, David. I really appreciate that. I know all the other committee members do, and I'm sorry I didn't give a round the table opportunity to others, but that's really appreciated. Thank you. Anybody else have any items that they'd like to bring before I adjourn the meeting? I guess not, so I'll adjourn this meeting of the city meeting and ask that everybody stay on who's going to be attending the Foundation for Excellence meeting.